In the autumn of 1929, the most celebrated financial mind in America stepped onto a stage to reassure a nervous public. Irving Fisher didn't just offer a forecast, he delivered a conviction that would become his professional obituary. He famously declared that equity prices had reached a permanent peak, a high plateau from which they would never truly descend. He dismissed the idea of a massive correction as nearly impossible. Just over a week later, the floor fell out. Within 3 years, the market had been hollowed out by nearly 90%. A quarter of the workforce was out of a job, and the banking system lay in ruins. This was the birth of the Great Depression. Fisher was no amateur. He was a Yale Titan and a pioneer of economic logic, but he fell victim to a singular lethal delusion. The belief that the rules of gravity had been suspended. He thought the advent of the radio, the car, and the power grid had birthed the miracle era where old-school debt and valuation didn't matter. At the economic of fallen empires, we track these cycles of overconfidence. Because today, the echoes of 1929 are no longer whispers, they are a deafening roar. Look around us in 2025. The slogans are identical. We are told artificial intelligence has rewritten the laws of physics. We are told the central banks have perfected the art of the soft landing. We are told that dips are merely gifts and that prices only have one direction, up. But the red flags aren't just visible, they are glaring. We are seeing record-breaking levels of borrowed money fueling the fire alongside. Massive bubbles in everything from housing to digital assets. There is a toxic level of arrogance in the air, where even the mention of caution is met with mockery. This is the delayed crash mindset, period, where the engine is smoking, but the driver keeps their foot on the gas because they think they can jump out just before the cliff. Over the next few minutes, I will strip away the illusions and show you why the psychological blueprint of 2025 is a carbon copy of 1929. We will look at the specific tripwires that exist, now the timeline for the coming fracture, and why history doesn't just repeat it, rhymes with terrifying precision. To understand our future, we have to debunk the myths of the past. Most history books suggest the 1929 crash was a lightning strike from a clear blue sky. That is a lie. The warnings were screaming for anyone willing to listen. The Roaring Twenties were a decade of relentless expansion fueled by a technological revolution. Household life was being privatized by the washing machine and the refrigerator. Productivity was through the roof, and the Dow Jones had surged 500% in less than a decade. The media called it a new era. They claimed the business cycle was dead, replaced by permanent growth. If that sounds like your social media feed today, it should here at the economic of fallen empires. We recognize that beneath that shiny surface, a mountain of margin debt was being built. Back then, you could control $10 of stock for every $1 you actually owned. It was a gambler's paradise. By the time the bubble peaked, this borrowed money accounted for nearly a tenth of the entire nation's economy. People weren't investing in companies. They were betting with money they didn't have. When the Dow hit its ceiling in September 1929, the internal organs of the economy were already failing. Steel output was sliding, car sales were hitting a wall, and joblessness was creeping up. Yet the market kept climbing. This is the hallmark of a dying bull market. Prices continue to rise on pure momentum, and debt even as the foundation rots. When the break finally came on Black Thursday, it triggered a margin call. Avalanche forced selling led to more forced selling in a suicidal loop. Even then, the leadership told the public to buy the dip. President Hoover insisted the economy was fundamentally sound. Those who listened were liquidated. This wasn't a quick bruise. It was a slow-motion amputation that lasted 3 years, eventually wiping out 40% of all American banks because they had funded the very speculators who are now broke. This is how a decade of progress vanishes, not in a day, but in a grinding, relentless erosion of wealth that leaves shanty towns where neighborhoods used to be. Now let's hold a mirror up to 2025. In 1929, the danger was 10% of GDP in margin debt. Today, the official numbers look lower, but they are a total illusion. The modern financial system has hidden its leverage in the margin. Shadows leveraged ETFs, complex options, and crypto platforms, offering 100x bets. When you aggregate the total amount of borrowed money propping up the system, today we are likely well beyond the insanity of 1929. We have retail traders using apps to gamble with the same fervor as the shoeshine boys of the 20s. Every time margin debt has spiked like this in the past, in 2000, 2008, and 2021, a catastrophe followed shortly after, but today's everything bubble is even more expansive. While 1929 was mostly a stock market fever, 2025 sees us at record valuations in stocks, real estate, and speculative digital tokens simultaneously. The S&P 500 is trading at nearly double its historical average, and home prices, compared to what people actually earn, have reached a level of absurdity that makes 2006 look conservative. The most chilling parallel, however, is the narrative. Just as they worship the new era of the radio, we worship the new era of AI. If you question the price of a tech giant today, you retold you simply don't get it. You're told the old math is obsolete. This is exactly what they said to the skeptics before the Great Depression. The language changes, but the human ego remains the same. We see influencers today promising effortless riches through holding forever, echoing the 1929 executives who claimed everybody ought to be rich. We are currently in that dangerous divergence where the underlying data-crushing consumer debt, record low savings, and slowing earnings is being ignored because the ticker tape is still green. At the economic of fallen empires, we see this as the bull trap phase. Buying the dip in this environment isn't a strategy. It is a gamble that the laws of economics will never apply again. Based on the 1929 template, the path forward is predictable. We are currently at the peak of overconfidence. The crack is inevitable, and it won't take much to trigger it, perhaps a geopolitical shock, a banking failure, or a sudden spike in defaults. Once the cascade begins, we will likely see a sharp 30 to 40% drop followed by a seductive recovery rally. This is the most dangerous moment where people are lured back in just before the real multi-year decline begins. By the end of this cycle, we could see unemployment in the double digits and a total reset of asset prices. This isn't a doom prediction. It's a recognition of a historical rhythm. To survive, you must act while the sun is still out. Scale back your risk, eliminate any debt used for investing, and build a fortress of liquidity. In 1929, gold was the only thing left standing when the dust settled today. The same principles of preservation apply. Irving Fisher died with nothing because he believed the hype. He mistook a bubble of cheap money for a permanent shift in human prosperity. He ignored the rot because everyone else was. We are standing in his shoes right now. The system is overextended, fragile, and fueled by a desperation to believe that this time is different. It never is. The Great Depression proved that the higher the climb, the more devastating the impact when the leverage unwinds. If you want to navigate the coming reset without losing everything you need to understand the mechanics of the collapse before they become front-page news, the pattern is a century old, and it is playing out in real time. Make sure you are subscribed to the Economic of Fallen Empires, because our next deep dive will reveal the specific sectors that will lead the slide and how to position yourself to be the one buying when everyone else is forced to sell. The cycle is turning. Don't be the last one left on the plateau.